In the latest issue of The Real Deal, we dive into a new era for some of real estate's top families, including a dispute among the heirs of one of New York's biggest property empires, and how real estate's daughters are sometimes becoming the heirs apparent. Plus, a check-in on the office market, trouble at a top residential brokerage, and a potentially powerful new tool for developers. This and more up next. So we were really focused on succession in this past magazine. Talked to a number of interesting people for your magazine piece. So tell me who you talked to.
Sure. My colleagues, Katie Brenzel, Catherine Kalergis, and I interviewed daughters from several large real estate families in New York and South Florida, including Danielle Neftali of Neftali Group, Carolyn Glesser of BD Hotels, and Jessica Goldman Srebnick of Miami-based Goldman Properties.
Yeah. So real estate has traditionally been a very male-dominated industry where with family empire, the son was really the heir apparent. Do you think that's changing?
I think a lot of these daughters were not necessarily groomed to take over the family business, but found themselves drawn to real estate after studying something else in college or trying out different careers. Danielle Neftali, for example, studied psychology before a summer internship in real estate changed the course of her career. Carolyn Glesser almost went to law school, and Jessica Goldman Srebnick was an associate fashion director at Saks Fifth Avenue.
What did you learn about the business as a whole from speaking to all of these women?
A lot of them weren't afraid to get their hands dirty, whether it was pushing dumpsters onto freight elevators or wearing hard hats at construction sites. They also seem to have the deep respect of their fathers, who often made them start at the bottom of the totem pole, but gave them plenty of room to find their passion and grow their passion within the business.
You can check out the article online now. Thanks, Liz.
Thank you.
So you wrote our cover story this month, which is about the Goldman family and a dispute over their property empire that's spilled down to the courts. Tell me first who the Goldmans are and why we care about them.
Sol Goldman was an investor. He started out in the 50s. He went through the 60s, 70s, became one of the most prominent investors of his time. He owned this huge portfolio. It included the Chrysler Building. He died in 1987. And since then, his company has been run by his daughter, Jane, and in some capacity, along with her brother, Alan.
So Sol died in 1987, and the empire's been run by his heirs since then. Tell me what this dispute is over.
So on one hand, it's over an appraisal. Maybe 14 years ago, the four siblings set up this system by which they can slowly, over a long time, cash out their stakes in the company, and the price they pay is dependent on an appraisal. Alan died in 2022. His son, Stephen, along with Alan's sister, Amy, have challenged the appraisal, saying that it's too low, essentially that they would have to buy their stakes out at too low a price. Mm-hmm. Jane stands by the appraised value.
Mm-hmm. But on the other hand, it seems to really be about sort of a family issue. Is that fair to say?
A lot of family issues. On the one hand, we get the sense that Stephen wants to be more involved in the business, and that's put him on a collision course with Jane.
Mm-hmm. So what was interesting to you on sort of a human level about this story?
I think really learning about the interpersonal dynamics here. It's a family company, and they would have preferred to settle this all behind closed doors. But they didn't. They filed a lawsuit, two lawsuits about it. And really, the question is, how did it get to this point? How did things get so bad? And I think that we learned that through their testimonies about sort of how bad things got.
Yeah. And what about as a business journalist, as somebody who's covered New York real estate for a long time, what interesting things did you learn about the way that their firm is run?
We got a look inside the firm that you wouldn't get otherwise, without litigation like this. And what was surprising is really how casually and sort of lackadaisically, things were run. Jean has this anecdote where she says, we didn't raise hands in our company and have votes. No one had titles. And we even see some of these like key entities are lacking really important paperwork that would tell us, what would happen in a dispute.
Yeah.
And no one really seemed to be aware of or really care that that stuff was missing until now.
Yeah. Thanks, Rich. So you wrote about an interesting new tool for real estate in the latest magazine. Tell me about the algorithm.
Yeah. So Gensler, which is an architecture firm, created this algorithm to evaluate which office buildings could be candidates for conversion. So what it does is Gensler plugs in 100 different data points, and the algorithm evaluates 5 different categories, which include things like, is the building close to public transportation? Does it have floor plates that are a good size? Are the windows openable, etc. And then it spits out a score, and the score says, yeah, this building is a good candidate, or not so much. There are different tiers there. So what it is essentially is a tool for developers to evaluate their portfolios, and also for cities to look at theirs. All of the buildings, some of which are quite vacant right now, and to see if they can make sense for residential.
Yeah. Tell me about the impetus for a firm like Gensler, which, like you said, is an architecture firm, to create a tool like this.
Yeah, so it was really right time, right place for them. Basically, the city of Calgary, which is in Alberta, Canada, in 2019 was dealing with really high vacancy in their office buildings, akin to what we're dealing with in New York, a lot of other cities right now. So Calgary engaged Gensler and said, can you help us see if these might be candidates for conversion? And the prevailing narrative then, and kind of now too, is conversion is hard or impossible. But Gensler wanted to fact check that. So they built out this algorithm. They looked at Calgary's office buildings, and they found in looking at 28 buildings that 10 to 12 made sense for conversion.
Mm-hmm. How helpful do you think that a tool like this might be for developers or for cities in the long run?
Mm-hmm. Yeah, I would say it's a tool. It's not a one-stop shop to say, look at my portfolio and does this all make sense? And one of the key ingredients that's missing is financing. Mm-hmm. And we know that projects don't make sense if they don't pencil. So that's something that developers have to sort of plug in on their own. It also is built to be location agnostic. Mm-hmm. So it doesn't factor in like zoning regulations in a certain city. And we know particularly like just looking at New York, that's a big deal. But I do think it's a way to make conversions and the knowledge, the how to do them more accessible at a time when we really need more housing. And also conversions could be a way to, help out a lot of these office owners who are dealing with defunct buildings, loans coming due, the possibility of default. So I think that is powerful.
So not a silver bullet, mm-hmm. but sort of a helpful step along the way to making more conversions hopefully possible.
I would say that, yeah.
Thanks, Susie.
Yep.
So tell me where we are right now in the cycle with the office market.
We've been hearing a lot from brokers about how things are getting better, and then we've been hearing from some people that everything is going to go to shit. We are kind of in this limbo period that we're not quite at hell, but we're very far away from heaven either.
How do we get into this sort of limbo purgatory position?
There's 2 problems. One is that banks seem to be extending a lot of loans of about the $700 billion of loans coming due in 2023. A majority of those were extended, which kind of tells you that lenders are wanting to extend these loans and make sometimes short-term solutions rather than permanent ones. I think a lot of these buildings will consistently trade for lower and lower prices or trade a couple times, and there'll finally be some more clarity for the market as to what office buildings are worth.
So to get out of the cycle, we're going to have to sort of still go through a little bit of hell and find the bottom first?
Yeah, I think so. I mean, I think there's going to be more foreclosures or more equity chipped in by developers in order to permanently restructure these loans. Yeah, there's definitely more blood coming. It's just kind of, I think, how much blood, and it seems pretty apparent it's all not going to come at once.
Right. What will it take to sort of push the market out of its limbo?
I think we are starting to see some short sales. We've seen a few of those. There is seem to be more clarity with leasing. Companies are, including some law firms, are making big leases. But I think it's really going to take just a lot of sales. I think that may happen over a number of years. And then I think the other way we get out of limbo is when banks really and lenders really start making decisions about what they want to do and whether they want to foreclose or whether they're really going to rework these loans. There's a lot of talk about interest rate drops, but I'm pretty skeptical that a quarter rate point is going to drop, is going to have a significant change in that dynamic.
So we could be stuck in this limbo if lenders keep kicking the can down the road for some time. Is that fair to say?
I think things are going to kind of spill out over time and lenders will make decisions on a case-by-case basis, but I don't see a lot of institutional investors. I'm not hearing about institutional investors looking to get back into big New York office deals.
It has been a tough season for brokerages. But in our latest magazine, you wrote about one brokerage that has some unique challenges. Tell me about that.
So I wrote about Douglas Elliman. And like you said, a lot of brokerages are having issues right now. I mean, the market hasn't been moving all that quickly, especially because of interest rates. And we're starting to see some of that change, hopefully, coming up. But Douglas Elliman quarter after quarter has posted losses, which again is not necessarily unique to them. They spun off from the parent company Vector Group in 2021. So they are kind of, newly independent. And for most of that time, they've been struggling with losses. So it's just, you start to look at the big picture and you see that over time, this brokerage, aside from that initial kind of craze of 2022, that there were so many sales and things were moving for every brokerage, they've kind of slowed down a little bit along with the market. And also, their share price earlier this year had dipped down all the way to about $1, which, on the New York Stock Exchange, if you go below $1, you risk delisting. And that share price has since gone up. Some executives bought some shares and some other things have happened that have pushed it a little bit higher. But, that also makes the stock price a little bit volatile. So anytime that happens in a company, kind of people are watching out for it. And in addition, they took out a loan that it was about $50 million. And, they're kind of saying it's built for, strategic growth and expansion. But the terms of the loan, it's a convertible loan. So the Kennedy Lewis, the asset manager, they can, convert that $50 million into stock for $1.50 share price, which would, kind of effectively, if that were to happen, would give them, between a 25 and 30% stake in the company, which is quite large. So, we saw that happen and that didn't necessarily move the needle, I think, as much as the company may have hoped. And so now we're kind of just looking for the rest of the year. They're at this unique point where if the market doesn't improve, they might have to start making some tough decisions. They've already been in a period of intense cost cutting. And moving forward, if you've already been doing that for a year, that it kind of asks the question of how much more can you cut and where? And it'll be interesting to see if the market does improve and other brokerages improve, what will happen for them as well, if that'll be the case or not.
This story is particularly interesting to me because we saw Howard Lorber, who is such an outsized figure in the industry, getting some heat from at least one investor. Tell me about that.
There was one investor in particular who kind of raised the issues about Howard Lorber. One of the things being his executive compensation. Every year at the annual shareholders meeting, they vote on executive compensation packages. This one investor was calling for the shareholders to reject his compensation. Particularly, he took particular issue with his bonus because the company had been losing money, and then he earned, a pretty sizable bonus. I think it was about 2.6 million. Part of that was a diversity, equity, inclusion. As we've been covering, there were two top agents at the company who have now been accused of sexual assault. And so this investor didn't necessarily say that was related to Howard, but just was raising the questions about, why is it as the CEO of a company collecting this full bonus for particularly for this issue when there are now these accusations floating around. Howard Lorber did, when he was at Vector Group, there were some investors that had kind of taken issue with his compensation package there. So it's not unprecedented for him as a leader, but it is, the first time that an investor has taken an issue with it at Douglas Elliman.
Right. But ultimately, Howard Lorber's seat on the board, bonus, compensation package, were all approved. So shareholders are okay, continuing the direction that they're going. Still, Elliman has been on a cost-cutting campaign. What are they doing, or what can they do to sort of right the ship here?
Yeah, so one of the things is continue to cost cut. We may start to see some bigger cuts. It takes a long time to, for example, office leases are one of those things. You're going to have to wait for those to expire, or else you're going to have to pay to get out of the lease. So we may, we'll keep following that, and we'll see if some of these bigger cuts come down the line, or if they start reaping the benefits. Sometimes it takes a while for spending cuts to actually materialize and to save significant savings. So we'll continue to follow that. For them as well, the market improving is a big one. They've continuously kind of heralded rate cuts as like a potential boon to the market. So I think that's, when you listen to executives talk, that's a lot of what they're hoping, will turn the ship around. It'll be really interesting to see whether or not that happens, and whether or not the relief kind of comes as fast as it might be needed. We are starting to see that, the Fed will probably cut rates in September is kind of what we're hearing. So that's a positive sign for the real estate market. But, will that actually translate into more transactions and in the kinds of things that would actually boost revenue? I don't know how long that will take. And so I think it's interesting to see, whether that pace can actually help the company turn it around, or if it will have to continue on this kind of cost-cutting situation. Yeah, thanks, Sharon.